When it comes to making money in the stock market, it's critical to know the fundamentals. There is a lot of confusion between the words investing and trading, which must be clarified. It could be dangerous to enter this realm not knowing the correct use of terminologies. It could lead to miscommunications and misunderstandings between you and other people involved in the process. You clicking this video means you have understood the importance of knowledge before anything. Let's not waste more time and get into it.
Pennywise, the channel focuses on exploring wealth and increasing savings through life-changing practices about personal finance, money earning and management tips, avoiding hoaxes, and so much more. Our goal is to equip you with a Pennywise mindset through your journey to fund and help you experience the life you desire. So please join us on this exciting adventure by clicking the subscribe button below.
Investing and trading are two very different ways to try to profit in the financial market. Both investors and traders aim to achieve profits by participating in the market. In finance, an investor is someone who holds a position or security for longer than a day and is a long-term player. Whereas a trader is someone who is influenced by the rise and fall of securities in the market. The words have significant distinctions as well as shifts in meaning when referring to how money moves in the market. It is crucial to know the terminologies to avoid confusion and efficiently and effectively make money. Let us first define investing. Investing is a long-term strategy for accumulating money slowly over time by using investing strategies such as mutual funds, buying and selling a portfolio of equities, bonds, a basket of equities, and so on. Investing is typically held for years and decades, with several benefits such as interest, dividends, stock splits, and more. Furthermore, owing to the fact that trends are eliminated in investing, there is no danger of downturns or market fluctuations because prices always have a chance of rising. Because it is a long-term investment, the investor will not have to worry about any particular downtrend because it will only last for a shorter period of time. Investors are more concerned about the market's fundamentals than about daily fluctuations. The fundamental market factors such as the price to earnings ratio are of great interest to long-term investors. However, long-term investing entails the risk of loss if you are unable to hang on to security through a lengthy downturn. For example, if you invested $1,000 in stock at the start of 2019 and held it for 1 year, your ending value would be around $942. However, if the market performance were to differ from 10%, with negative returns occurring about 1 out of every 4 years, this could change significantly. Some stocks may never recover to the price you paid for them. When investing, you must remember that the return will not be immediate. It is like planting a seed, taking care of it, and harvesting the fruits at the right time. You should also ensure that you would not need the money in a short time frame. Patience is the key to this kind of money-making technique. Failure to do so could lead to the failure of the process itself. Investing might be the right path for you if you prefer stability and low-risk schemes. How about trading? Trading is a quick and volatile procedure that entails frequent transactions depending on the market's trends. It is much shorter than long-term financial instruments such as mutual funds or bonds. Trading is the practice of buying and selling assets, commodities, currencies, or other financial instruments in order to make a profit. Trading has a greater potential for profit than investing. Assume that long-term investors get 10 to 15% of the profit each year, and the trader may expect the same 10 to 15% return on their monthly trades. That is not all. However, trading is dynamic and volatile. It's a high-risk money-making technique where the market movements impact trading directly, with both significant gains and losses. Traders employ a variety of strategies to make money in less advantageous situations. They attempt to profit within a specific time frame and frequently utilize an automated stop loss order to close losing positions at a predetermined price level. Technical analysis tools such as moving averages and stochastic oscillators are commonly utilized by traders to discover high probability trading opportunities. The most fundamental rule of trading is to buy when the price is low and sell when the price is high. Still, experienced traders use various techniques, such as reverse trading and short selling, to generate significant gains in the near term. These are high risk techniques that should be considered and thought of carefully. Novices should take extra precautionary measures before entering. A trader's approach is defined by the length of time that equities, commodities, or any other sort of commodity are bought and sold. Traders usually fall into one of four groups. Position trader. Positions are kept for months or years at a time. Swing trader. Positions can last from days to weeks. Day trader. Positions are held for a day with no overnight positions. Scalp trader. Positions are held for seconds to minutes before being released. There is no overnight holding. If you have decided to enter trading, take a self-reflection and assess yourself on what you could handle. Ask yourself if you are willing to take chances for a petty profit at the cost of the risk that comes along with it. Involving yourself with a group of experienced people could help make your decisions. Do not hastily enter anything and calculate first. If you are a person willing to take big risks and accept potential significant losses, trading might work out for you. Both ways have their share of advantages and disadvantages. Whether you decide to trade, invest, or do both, understanding the world is still the most important. Research, join groups, open up your mind, and educate yourself. Do not be afraid to ask questions. However, also, do not be too adventurous and make hasty decisions. Finding the right balance for you is still the best way to go. As always, Pennywise is always here when you feel lost on the track. If you want to learn more about finances, consider subscribing by clicking the big red button below and ringing the notification bell to get notified when we upload new videos. Feel free to like and comment your thoughts so we'll know your feedback. Thanks for tuning in and see you again in our next video.